live webinar, first of the week. It is Monday, the 13th of October. I'm delighted to have with me new guests today from ISS Stocks Economic Value Added. Gavin Thompson is the Global Head of Research, and Casey Lee is joining us. So welcome to both of you, gentlemen. Gavin, you're going to be talking about EVA Asset Allocator. Crack open the box. What are you going to talk about?
Yep, thank you very much, Andrew, and thank you for hosting this. So EVA Asset Allocator, really today what we're going to talk you through is what we describe as a top-down view of the world. So really thinking about that top-down, what does that mean? Thinking about the macro, so where are we in the economic cycle? What kind of sectors would we be looking at this point in the economic cycle? And then also what kind of countries and regions are looking like through the EVA lens today. So we have quite a full agenda, but hopefully sort of the key takeaway today will be, okay, where do I want to deploy my money across the different equity markets today, and what sectors look more attractive?
Very good. Okay, and before I turn my camera off and let you guys run with this, I'm going to ask you to go on to slide 2, and if you can hold up the disclaimers for about 10 seconds before you open up to your slide. Interactive Brokers always asks us to put up some disclosures. We might be talking about risky assets, products, and so on, so we always put some disclosures up. And we're going to do a Q&A towards the end of the session. If you use the chat panel to enter any questions, I'll keep an eye on those throughout the session, and we'll raise those questions for Gavin and Casey later on. The handouts that are currently being displayed are going to be available on the website later, but if you go to the handout segment of the GoToWebinar panel and expand it, little white triangle to the left of the word handouts, you'll see the link to the PDF. You can open that and download it to your computer. And again, we're being recorded live here today in about 2 hours after we wrap up, so maybe 3 p.m. Eastern time this afternoon, you'll receive a link to the recording of today's event, which will be on the Interactive Brokers campus website. So with that said, I'm going to go on to mute and hand over to Gavin and Casey.
Great. Okay, if we slide forward to a rough idea of our agenda today, and perhaps before that, if I just do a proper introduction, and thank you for Andrew for describing my current role as Director of Research. So I've been at ISS EVA, which is part of the ISS Stocks business, for now 6 years. Prior to that, I was actually an equity portfolio manager for 15 plus years. So have a lot of buy side experience, and really sort of that's how we work with our clients today. So both writing research, and that research is available to all Interactive Broker clients. Something we built out at the beginning of this year was also our iframe. So it allows Interactive Broker clients to port directly to our research hub, so please do look out for that. And you'll see on average we're producing around sort of 7 to 8 research reports a week, and you can see we actually covered 29,000 public equities. So for pretty much each and every one of them, we have a company snapshot that is also available to Interactive Brokers clients. In terms of agenda for today, I kind of mentioned it earlier, but just in terms of some of the specifics, we did a webinar a couple of months ago, but for those that didn't attend and for those who are new to EVA, I think it's good to have a kind of an EVA 101 recap, exactly what is EVA. Then coming on to where we are in the cycle, there's just a little sort of top-down macro chart that we're going to look at there. Market view through the EVA lens, what are we seeing, what are we sort of recommending at this point. Region country focus, so that's thinking about sort of Asia versus Europe, US versus Europe, before going on to sector opportunities. And a little bonus content for everyone is interest rate cuts and EVA, obviously with interest rates coming up. It'd be interesting to see how EVA has performed, and the movements in EVA we see around interest rate cuts. Okay, on to the next slide. I should have just paused there for Casey to do a quick introduction from his side as well. I don't want to steal the show completely, Casey. So do you want to do a quick intro from your side?
Sure. Casey Lee, the Director of Quantitative Research here at ISS EVA. I've been with the company since they purchased EVA Dimensions back in 2018. I create all of our backtest work, and I also work on the communication services, healthcare, and financial sector. Yep, I'll turn it back to you for the EVA 101.
Thanks, Casey. So the next couple of slides are the refresher slides, or those that are new to EVA, just to understand kind of what the concept is. It's not a new concept. It's been around since the 1990s. Really been sort of an institutional investor case since sort of 2016, 2017. The business was acquired by ISS back in 2018, and really sort of we've continued to grow the business with different use cases across both the retail investor side and the institutional investor side. So EVA, economic value added. What we do is take the cleaned up net operating profit after tax. So when I say cleaned up, what we're doing there is making a series of adjustments ready to get rid of accounting distortions. So what we're ultimately trying to do is give you, the investor, the kind of level playing field to compare Apple, the US tech giant, with Scania, Swedish truck manufacturer. We know in traditional accounting that's very hard to do because of different accounting standards, different adjustments. Ultimately, it doesn't matter whether you lease or own your assets. We're backing out the adjustments that accountants might make to give you that cleaned up NOPAT number as a starting point. We're then introducing a hurdle rate in the form of a capital charge, and that's to see if the aggregate or company is generating a true level of economic profitability, right? So we're not talking about accounting profit, we're talking about economic profit. And having that hurdle rate is kind of what we expect, or the minimal acceptable returns that all investors should be expecting. That capital charge is made up of two elements. So capital, that's the total sum of debt and equity in the business. And then the cost of capital is the, we calculate using a CAPM, so capital asset pricing model, for the cost of equity. And then for the debt portion, we model in based off of bond yields. Okay, so next we're going to recap on EVA fundamentals, and you'll see at the bottom of this chart, you've just got the maths behind what we called our EVA fundamentals, starting with EVA margin. So this is our profitability measure, our economic profitability measure, and the math behind that is pretty simple: EVA divided by sales. So you can think of it a little bit like an operating profit margin. EVA momentum, that's our growth indicator, and that's the incremental change in EVA divided by trading sales. So change in the EVA divided by trading sales. So let's go to the next slide to look at this in practice. So you can see on this chart we have the red line which is our EVA margin, and the blue line which is our EVA momentum. So EVA margin, which is our profitability indicator, really the percent of revenue that remains a true economic profit. We know it's fully loaded for capital invested in the business. We just saw that. And that basically means that if EVA margin is above zero, it means the company is covering its cost of capital and generating true economic profitability. And EVA momentum, our growth measure, as long as EVA momentum is positive, then we're seeing a compounding of growth. So a creation of new incremental EVA. And I really like to think of that blue line, that EVA momentum, as kind of a business model momentum indicator. So you can see for this company, it's actually a US retailer that's up on the slide. The EVA margin expansion story was incredibly strong from that 2010 to 2020 period, expanding from 2-3% EVA margin up to over 10% at the peak, just around COVID times. And that's what we would really look at for a wealth compounding kind of really strong value creation story. Great if we can find lots of companies that look like this. And then what happened actually is a peaking in economic profitability, and you can see the EVO momentum kind of had started to falter around that sort of COVID periods. Obviously, a lot of volatility was going on, but out the back of 2021, actually, EVO momentum turned negative, and this company's really struggled with quite a big contraction in EVA profitability. Generally, we say you don't want to be owning a company or a sector or an industry while it's rolling over in its profitability. And really that rolling over, we can talk about from an EVA shock perspective as well. We talk about EVA shock as that change in direction of EVA momentum, and really sort of accelerating or decelerating. And we use EVA shock a lot in investment timing, because certainly if you're looking at a positive EVA inflection, as we saw kind of around that 2023-24 bottom in momentum, so it was negative but bottomed out, started to improve, and actually you can see the blue shaded area is the absolute stock performance for this stock, and had kind of tracked pretty well with that change in momentum. We also care about the future, so you'll see that we have the consensus EVA margin and momentum modeled in, so that solid shaded line, that solid shaded red line out for a 5-year window, also talks about basically using the IBIS consensus, so the sell side consensus, with the EVA adjusted sort of those add backs. Some of those add backs in particular we look at is capitalizing rent and R&D, so we capitalize as opposed to expense a lot of traditional accounting areas. So EVA consensus gives a view of what's out there in the sell side, and then the last one is looking at that crosshair, so those little circles talking about the 5-year window of EVA stream required to get back to today's share price. So this is where the DCF kind of aspect comes in. So instead of using cash flow required to back out today's market value, we're using the stream of EVA required to factor in what's in the market. That also starts to build in that expectation story. So you can see here when the crosshair is above the current level of EVA profitability, it suggests the market's pretty optimistic on the outlook, which, if we go to the next slide, starts to introduce our investor expectation story. So we spoke about fundamentals. This is now thinking about what's being factored in by investors, and the top left, or that left chart, can look a little bit scary, but I'll break it down in more simple terms. But starting with the blue bars, that's our capital. So that's all the capital invested in the business. That includes working capital, net PP&E, add and promotion, everything that in kind of more simple terms, I think that's kind of what you own as the investor, right? So that's what's being put into the business. Then if we look at the red bars, we call that CVA, or current value added, and that's today's dollars of EVA divided by the cost of capital. Think of that as like the retained earnings story. So if I said the blue is what you own, the red is kind of what you earn off of your capital base. If you added the blue and the red together, you'd come up with a franchise value. We know the market doesn't price things off of franchise value. So then what we go one step further is model in the market value. So that orange line, that's a given, it's the market value. And we look at the plug between the franchise value, so the blue plus the red, minus the gray, which we come up as our future value added. And really all that's doing is just representing the embedded expectations in today's share price of value creation or destruction. Now, these are all in dollar terms. We know the world doesn't work in dollar terms when it comes to valuation. So what we then do is scale that gray part, so that FVA, against the market value, and come up with that chart on the right called future growth reliance. And future growth reliance is our kind of PE, price to earnings equivalent. And you can kind of look back over history and look at where we're trading today. So for this stock, trading at over 25%, actually looking back over history, that's a pretty elevated level. So certainly looping that back with what we saw at the EVA margin level, the market's very optimistic about value creation going forward. So optimistic that actually we're trading at sort of pretty much historic levels of premium. So the market's very bullish on the outlook for this story. So that was a quick refresher. And now we're going to move on to the start of the top-down view of the world. We thought this chart was a good starting point in terms of where we are in the economic cycle. And to start with, certainly we need to figure this out. And we thought actually it's maybe in today's world, it's not a particularly easy question to answer. And if we start on the left between that overheat and recovery and start to sort of work through the checkpoints. So equity markets are on their highs. Cyclicals, particularly early cyclicals, are outperforming. Small caps have been playing catch up, but generally large performance, but certainly small caps have played a bit of catch up more recently. Both growth and value are kind of working, although there's been a massive value tilt at the moment, but certainly pockets of growth are working. We've come from a period of high inflation, but inflation certainly remains sticky. And I was reading something this morning talking about 3% plus inflation still in the US is expected. So we know the sticky inflation is leaving central banks to lower rates at a slower pace than initially anticipated. Growth is slow, but has generally held up. So really, when we add all this together, we're pulling us somewhere between that overheat and recovery stage, which is interesting because normally you would have thought that you go from an overheat to some kind of landing. And if we look at the right scenarios, you see, first of all, that upper right soft landing. And that was definitely the story more from a 2024 kind of narrative in the sense of looking for a soft landing. But low growth is still the concern, but so far, as I said, growth has held up and inflation has come down, but remains pretty kind of sticky in some areas. Equities are seeing large outperformance versus bonds. So certainly from an asset class perspective, bonds are not working. And yet to really see a soft landing scenario kind of play out at this stage. So parking the soft landing to one side. Then if we look at that lower right, the hard landing, and that's certainly what we're saying markets are not factoring in, and an avoidance of a full-blown recession at this point is clearly what the markets are expecting. Cash continues to be a significant drag. We're looking at equity market performance, and most equity markets are sort of double-digit performance year to date versus cash, which at best is probably 4 or 5%. Defensive is also not leading. Actually, if you look at consumer staples, the consumer staples global sector is actually the worst performing year to date sector year to date. So in conclusion, we're seeing somewhere between that overheat and recovery phase. So equities, commodities, some early cyclical sectors, and value working with pockets of growth. And on that story, I'm going to hand over to Casey, who's going to walk us through the factor performance just to see how clearly that valuation story has been.
Thanks, Gavin. So these graphs are the compound log returns of going long short our quality and value scores. When the lines are going up, that factor is working. So good quality is working or cheap valuation is working. And quality incorporates the profitability metric that Gavin outlined on slide 4. That's EVA margin, EVA momentum. And then we risk adjust that profitability, looking at the volatility of share price and the volatility of profitability. We look at cash flow generation and the debt to capital structure. Our valuation score is based on the metrics Gavin mentioned on slide 5, looking at future value added, looking at that future growth reliance, how much of the market price is coming from investors' expectations for the future. So we produce these graphs on a weekly basis and a monthly basis. We include them in our Quant Corner, and we also include them in what we call our monthly pivot factor reports, which we do for the global US, Asia, and Europe regions. So cheap value started the year strong in global large cap. In March, value started to roll over and quality started to outperform as markets dipped. After the market started to fully recover in June, we start to see cheap value working and quality started to struggle. As investors added to risk positions, as I mentioned, our quality score includes that risk-adjusted profitability metric. So as riskier companies outperform, the quality metric tends to underperform. In the small cap universe, cheap value has worked consistently from the end of 2024 without that rollover in March and April that we saw in the large cap. Quality did have strong performance during the market's shock and initial rebound, but like the large cap universe, has seen a decline since June. Here we look at our different EVA factors. On the left, we have our heat map, which is a nice visual tool to pinpoint a company's place in terms of quality versus value. Quality is on the y-axis, where higher is better quality or more risk-adjusted profitability. And valuation is on the x-axis, where further to the right is cheaper. So in the upper right-hand corner, we have the best of the best. These are companies with the highest level of quality and available for a cheap price. This zone has generated, we call this the best of the best. This zone has generated strong outperformance over time, as these names can see good performance during a quality or value run in the markets. To the left in that heat map, we have expensive but worth it, and its corollary, the overly expensive quality. In the first one, the names are expensive, but the strong risk-adjusted profitability justifies the price. Whereas in the overly expensive quality bucket, the valuations are not enough to justify the price. In the lower right-hand corner, we have the cheap value zones. Quality is much lower than the zones above, but value investors find attractive names down here. We note in the backtest table on the right that both the attractive value and the value trap zones have shown strong performance over the last 3 and 5 years. And finally, we have the lower left corner, the worst of the worst names. These are expensive names with low quality. Historically, this zone underperforms, but we do see these names run during certain jump rallies. These names tend to trade more on news flow, like early stage biotech, early stage IT companies, etc. We see that over the last 3 months, we have experienced a bit of a junk rally with this zone generating some outperformance, which we see in this table on the right. On the lower right, we have all of the factors that go into our zones and all the factors that go into our prove it score. As I mentioned, profitability and risk lead to our quality score. So here our quality score has been negative as investors have added to risk. So these are positions where risk is companies that are high risk are being rewarded, and investors are shying away from the lower risk names. You will note that our profitability trend, P2 score, has seen some outperformance, even as quality has been off, as investors look for companies that can grow profit, especially in a low growth environment. Here we see the average monthly spreads for the factors that we showed on the previous slide across various regions. This graph is available on a monthly basis in our Prove It Factor report for the global universe. One interesting takeaway is the underperformance of value in North America, while cheap value has generally worked in all other regions. That's the green bars here. We also see negative spreads on risk in most regions, with the exceptions being Latin America and the Middle East, Africa, as globally investors are rewarding riskier companies. Profitability trend, the growth metric, has worked everywhere except Asia and the emerging markets, and these two regions have a lot of overlap. So each month we include sector attractiveness in our regional Prove It factor reports. Backtests have shown that looking at the average Prove It scores for countries and regions can be a good indicator of market performance. We have listed the sectors from most attractive to least attractive based on the overall global score. So financials look the best overall and communication services look the least attractive overall, but there are some regional differences. In the US, financials are not as attractive. They are above the country average of 47. So here, this is the country average of 47, but consumer staples, consumer discretionary, and materials look more attractive. Germany and Europe look more attractive than the UK, although British industrials and communication services score very well. Asian financials have some of the highest scores outside of Japan. Overall, China scores as neutral, but has a number of very attractive sectors: energy, financials, utilities, and the consumer zone sectors. And now let me turn it back to Gavin for a little more detail on the countries and regions.
Yeah, thank you very much, Casey. And the charts I'm going to go through in the next few slides are actually from one of our recent monthly country scorecard papers. So certainly do look out for that research. And it's a fairly new style of report that we've been putting out on a monthly basis, and also lives with our sector scorecard. So two great research reports to look out for. So if we start with the upper left chart, so the upper left chart shows the global aggregate EVA fundamentals and includes the consensus line. Global aggregate EVA momentum, so that growth, that blue line is hovering close to zero by the end of, so these numbers are to the end of September, so pretty up to date. You can see that growth recovery story has been really strong. So recovery from the lows of minus 1.9% at the end of 2023, and seen a really sort of strong recovery over the past couple of years. Certainly, we think that's been a big reason why equity markets have performed so strongly during that period of economic growth. So what about the future? This is where we've become a little bit more concerned, because definitely consensus, so when we model in that consensus, has continued to edge down in the outlook. Now predicting EVA momentum rolls over in the fourth quarter of this year and contracts until around the second half of next year, so into the second half of 2026. So far, the market's been looking through the risk of slowing growth. Certainly focus on those areas of where there is growth, and a lot of that is obviously AI related across to tech infrastructure as well, and also the bet that stimulus comes through from in the form of monetary easing by central banks. But certainly, if either of those were to falter at this stage, we are set up for a continuation in the outlook for growth, and we can see that on that upper right chart, just showing how much sort of future growth reliance there is out there today. The bottom chart actually shows it in an even bigger way, in the sense of the grey bars, which we spoke about in the previous slides, talking about future value added, so that embedded expectations for growth going forward. Really what's happened is, as the earnings kind of story has continued to decline, the market's become more and more optimistic about the recovery story coming through. And you can see that when we do look at our FGR, our PE equivalent chart, we're back to 1999 levels of expectations. So currently, roughly 42% of market value is dependent on that EVA growth coming through in the future. The previous peak, for context, was in 2002, and that was 55%. So at 55 versus the 42% today. So you could argue we've still got a bit of headroom for that final blowout in equity market performance. But equally, we'd like to say that the market's certainly not factoring any slowdown at this point. So if consensus is correct, that might be a bit of a short-term shock for the market. But we know that equity markets should be discounting mechanisms and should be looking at 6 to 12 months ahead. So whether the market's ignoring that shorter term pullback and still looking at sort of the second half 2026 ongoing improvement story. But certainly we'd like to say kind of markets are priced for pretty much the perfect growth story at this stage. And if we think sort of going back to our economic cycle chart that we showed, the current market is certainly not reflecting any form of a landing at this stage. We don't show the EVA drivers, but some of you might be interested to just understand what's been driving that recovery story in economic profitability. When we look at our EVA drivers, so we have sales growth, that's been positive since mid-2024, but we've seen a bit of a slowing more recently, but we're still sort of running around 2% levels at the end of September. So sales growth is okay, but not particularly that strong at this point. EBITDA margin, and I stress the R when I say EBITDA plus the R, that's representing those accounting adjustments, those add backs we're doing in the EVA world to kind of come up with that cleaned up profitability measure, excuse me, has been very strong and is actually maintaining around the record highs. So a lot of the growth recovery story has come through the P&L profitability. It's been incredibly strong, but we have seen some more recent pressures via SG&A. So SG&A, sales general administrative, we certainly saw labor costs increase through the inflationary period. And then SG&A had been kind of coming back until very recently. So definitely one to watch is just, is there an aspect of labor inflation or labor costs working through the system at this point? You could obviously tie that in with the AI story in the sense of whether actually there is much upside risk from labor costs if AI continues to be heavily adopted. The other aspect is also new investment. So new investment is remaining high and has certainly pressured our asset efficiency story. And again, that kind of ties back also with a lot of the AI, artificial intelligence related with just huge investment being seen, but also maybe with the tariff story. So companies being almost forced a little bit more to be investing in more domestic facilities at this point. So that's the global picture. Let's move on to the next slide, which looks at the US versus Europe at this point. The US has been a long improving journey, and that again sort of similar to the global one, not surprising. Since Q1 of 2024, EVA momentum positively inflected, and today economic growth is actually above zero, which just shows how far the journey in recovery has been. That actually positive number is the first time in 3 years that we've seen value creation kind of coming through. Consensus expects growth to continue through to 2027. So certainly it's difficult to be negative on a market where we've traveled a long way, but that improvement does look to be continuing from a fundamental perspective. And interesting, just looking at where EVA margin has kind of bottomed, actually it's bottomed at the upper end of the long-term range. So ignore the COVID kind of spike up, but if you look at that long-term level of economic profitability, around sort of the 2.5% plus level, economic profitability is starting off from still a relatively strong point. So certainly the US message is very strong from a fundamental picture, but when looking at valuations, so moving to the right, you'll see that the market continues to push higher. So a new higher level of premium. In fact, the FGR is flirting with the 2002 all-time highs as of the end of September. And our caution is the market is priced for perfection, and that does make us certainly aware of if that growth trajectory is not met, then certainly some downside risk there. With the caveat is, or the caveat of, when growth is scarce, we have often seen investors are willing to pay a higher and higher premium for that growth. So again, everything's linked to that growth picture for the US, but the key takeaway is that it's priced for sort of the perfect growth story to come through. Europe, on the other hand, is at a pretty different phase at this point. So although EVA momentum has seen a recovery through 2024, the recovery has not been an easy one, and EVA momentum today remains negative, although slightly negative. It was interesting, actually, consensus does suggest a pullback, and actually we've seen a bit of weakness in that consensus view, so actually more of a negative consensus view more recently. So expecting a pullback from these levels and then a bottoming out in the first half of 2026. So again, if you think the market's sort of willing to look through that slowing over the next couple of quarters, certainly when we look at the valuation picture for Europe, valuations in Europe are clearly much lower. So with FGR around 22%, so 22% of market value dependent on growth versus the very lofty levels in the US. So although reflecting a slower outlook, certainly the valuation story is much more supportive in Europe. If growth can not have that much of a fall down and see some support through into 2026, we think there's an opportunity from a European perspective. Okay, next slide. So here we look at what we call two value-orientated markets. So the UK and Germany. Germany at the top, and Germany's really struggled to gain traction the last 2 years. You see pretty much moving sideways from a EVA fundamental perspective. EVA margin is negative, and really Germany we see as a kind of like a turnaround story, but it's clear it will take still more time for that turnaround to come through. However, when we look at expectations, and we look at expectations slightly different, when profitability has been historically negative the majority of the time, as is the case for Germany, what we do is then use our price to book measure. So our economic price to book measure, you can see that's called market value add spread. So in the same way you'd use in traditional finance, you'd use a PB ratio instead of a price to earnings ratio. We're looking at things from that PB perspective, and what we're doing there is valuing it off the capital base. So instead of the earnings base, we're valuing it off the capital base, and you can see that MVA spread, so that economic price to book's around 29%. It's around sort of the mid to slightly upper range, but certainly we're pretty comfortable with relatively low expectations for any form of recovery at this point for Germany. And again, consensus has started to suggest it's a slower recovery, but that recovery certainly comes through in the latter half of 2026. I think actually we'll see China in a bit, but I wonder how much of that is linked also to the China story. And then the bottom charts look at the UK market. So the UK's seen a decent recovery trend, but growth remains negative at this point. Expectations are, however, also among the lowest, with an FGR of only around sort of 15%. The market doesn't tend to trade historically with a very high premium, but certainly pulling it into context with the other global markets at this point, the UK is looking like it's trading pretty cheaply for a number of reasons we know, but again, the growth outlook probably looks fairly supported from current levels. So the UK trading is a real value market at this point. Okay, next slide. So now we're going to look at Asia. So Asia ex Japan has continued to see downward pressure to EVA fundamentals, and EVA margin has contracted to 0, which is the lowest level since 2002. And expectations for the rebound continue to build and are reaching close to 2007 highs. So certainly we're pulling on the elastic in the sense of things are getting worse, but expectations are sort of moving higher, which makes us a little bit nervous that so far we haven't seen that true kind of bottoming story in sort of across Asia as a whole. But with current profitability so depressed, we'd like to think that there is a potential sort of cyclical rebound, but a lot of that rebound's already kind of priced in. So certainly we'd be waiting for more confirmation from a bottoming in fundamentals, and a lot of the pressure has come from China. So the bottom charts show China, which is certainly searching for that trough or that bottom in profitability. Continues to see consensus revising down, so that's the one market where we really see a lot of downward consensus revisions. EVA profitability is negative, the lowest since 2000. I haven't gone that far back on this chart, but actually it's since 2000, and that downward trend's really sort of been a constant from 2022. Expectations have moved higher. You see Asia as a whole, expectations have moved even more stretched at this point, but certainly the market starting to believe the recovery, or we're getting closer to the recovery, and consensus does expect sort of the second half of 2026. So while we're short-term cautious, really sort of want to see, again, as we're talking about the whole of Asia, we want to see more of a genuine confirmation of the bottoming coming through in that market. Next slide. So these are two, we spoke about Germany and UK as two value markets today. These are two markets that used to be value markets that we don't think offer the value they did before, as in Japan and South Korea. So Japan historically has been one of the biggest value destroying markets out there. Generally a negative EVA margin kind of story, and that really sort of changed the post-COVID. So around sort of 2020, you had a big spike, and then the post-COVID profitability has remained in a much stronger shape than it did prior to sort of the 2000 or 2020 period. But profitability today has reverted back to around 0. So certainly, again, corporate Japanese P&L profitability has improved. When we're looking at that EBITDA measure, we're seeing that's trading around all-time highs. So clearly, from a Japan corporate perspective, profitability, the underlying profitability story has become that much better. However, sales growth has struggled, and generally, I think sort of consensus, although it has a very strong outlook for a second quarter recovery, I think maybe a little bit too optimistic in that bounce back at this stage. Investors have started to believe more in the recovery. So again, we're looking at our price to book equivalent with that MVA spread for Japan. And actually the MVA spreads moved above the upper end of the range, which you could kind of argue is a bit of a breakout from a book perspective. But again, we're kind of looking for a bit more confirmation coming from Japan at this stage, particularly as there's so much of the market that's very, very cyclical. And then South Korea is very depressed in EVA profitability. In fact, the lowest level of all the countries and regions we're looking at here. EVA momentum is positive, but has also started to roll over, and valuations are not that appealing. So not particularly positive on either of these historical value markets. And then if we move forward, this is the last of the regional charts that we're looking at, and we're covering off Latin America here. So the surprise region maybe for some, because certainly while tariff uncertainty exists, the current level of profitability is quite strong in the region. In fact, when we look at the profitability story for Mexico, it's only 10 basis points lower than the US at this stage. So EVA margin, only 10 basis points lower than in the US. And for almost the same level of economic profitability, you're only having to pay a premium of around 24%. So certainly valuation versus profitability story, I think, certainly makes Mexico look very attractive at this point. And EVA momentum has also been recovering from Q1. So again, we're seeing quite strong support from a profitability perspective at this stage. Obviously, there is still a lingering kind of tariff uncertainty, but the profitability profile versus valuation story does certainly suggest Mexico looks attractive. And then Brazil, I think Brazilian market performance has been pretty strong this year, has seen a larger contraction in EVA margin, but again, actually the current level is above the US level of profitability, and valuations are also relatively cheap. I guess the trade-off sort of, or the outlook between Mexico and Brazil, the consensus kind of view is that Brazilian profitability is more pressured from here. So certainly from the two LATAM markets, we probably err towards Mexico from that perspective. Okay, the next slide actually sums up this from a table perspective, and I'm not going to go through everything here and repeat myself, but I think kind of it's quite nice to visualize, first of all, looking at those arrows, and that's showing the EVA margin change. So the latest quarter EVA margin change for each of those markets. The amber shaded countries or regions are markets where we're definitely a bit more cautious on. So the global outlook, we said about sort of that caution, just where we are with profitability, valuation trade-off. Japan, again, we kind of earmarked or outlined the more cautious view there, versus those regions and countries in the white, which are a bit more of a neutral kind of view. So US, we said it's hard to ignore that momentum growth story when it's just so strong at this point, but it is priced for perfection. Whereas Europe, maybe a little bit of downside pressure in the shorter term growth perspective, but certainly valuations are much more appealing. You can kind of see that FGR 21.9 versus the 52.4 in the US. And then we come onto the green, lighter green shaded areas. So Germany, UK said the more attractive value markets, and then the darker green market, Mexico, which as we said is a bit of an interesting standout at this stage. So with that, I'll hand back to Casey, who's going to drill down on a little bit more on the sectors.
Yeah, thanks, Gavin. So we look at looking at our sector attractiveness for the global universe of companies with a market cap over 1 billion. We typically refer to this as our sort of all cap view. We highlight financials as one of the most attractive sectors, with the second highest score for risk-adjusted profitability, that quality score, and the third lowest valuation score. Well, it's tied for third. Consumer staples is the next most attractive sector with the highest quality score and a valuation score just below the overall aggregate. So that's 52 versus the 54 for the universe. Finally, the utility sector is ranked third, with weak quality being offset by the second lowest valuation scores across the sectors. At the bottom of the list, we find the unattractive sectors. Energy does not score, energy scores as extremely cheap, but overall the quality is just too low, so the quality value trade-off looks unfavorable here. In the wider tech universe, we see lower quality and some of the highest expectations amongst the sectors, making IT score as unfavorable. And finally, the communication sector also sees an unfavorable trade-off between quality and value, although both are below average. Now we look at just the large cap names. So here we're looking at 10 billion and above. If we focus on the large cap results, the sector attractive list does see some changes. Large cap healthcare, above 10 billion, look attractive in the Prove It framework with slightly above average quality, but also higher than average valuations. The larger cap names average a much higher quality score than the all cap on the previous slide, with only a slight increase to their valuation score. Large cap IT sees a large jump in quality from the all cap sector average as the sector leaps from the unattractive list on the previous slide to the most attractive list on the large cap space. Expectations do remain quite high here as well. And finally, large cap financials look attractive as again we see the large cap names coming with a much higher average quality score. At the bottom of the list, this time we see materials, energy, and utilities. In materials, we see a small bump in quality from 42 to 45, but a significant jump in valuation, which pressures the overall favorability of the sector in the large cap space. Large cap energy looks like all cap energy, very low quality and cheap valuations, but still not cheap enough to make the quality value trade-off look attractive. Finally, the large cap utilities come in with a lower average quality than the all cap average, but like materials see higher expectations than the all cap universe, which pushes the sector from slightly attractive in the all cap space to unattractive in the large cap space. On a regular basis in our quantitative reports, we gauge these expectations that Gavin has gone through and built it into a single chart. Here we plot the historical future growth reliance as the gray bars. The orange lines are the mean or 10-year average of the sector. The aquamarine lines are the one standard deviation above and below the mean. And of course, the current future growth reliance is the green dot. As the slide title notes, most sectors in the large cap space are around their one standard deviation and on the high side, with an exception of energy, which is at its average. The small cap view is a little more conservative than the large cap for many sectors. Communication services, staples, energy, and the utilities are all below their one standard deviation high point, but none of the sectors are below their historical averages. Now, before we get into the Q&A, I wanted to take a quick look at some of the work we have done with some rates. Given the recent Fed rate cut, we wanted to look at the correlation between the Fed rates and profitability. Here we have the aggregate profitability as measured by EVA margin and the aggregate growth and value creation as measured by EVA momentum for the aggregate US market plotted alongside the Fed rate. In the late 90s and early 2000s, we see high correlation. EVA margins inflected higher in 2002 and can continue to climb after rates started going up in 2004 and even moved up after rates had peaked. When the rate cooling kicked in, EVA margin rolled over and dropped precipitously in 2007 and 2008. Rate cuts did not stop the bleeding there. But more recently, the 2022-2023 rate increases started when the aggregate profitability was already at an all-time high. Growth and profitability dropped immediately. Growth fell into negative territory, but profitability only fell to levels which were at the upper end of the profitability range historically, pre-COVID. Profitability has leveled out for almost a year, and consensus estimates call for a strong recovery. While the economy may continue to face looming headwinds from tariffs and continued inflation, the Fed's ability to continue to cut rates, which will lower the cost of capital for companies, may provide some improved profitability in the short term. On the next slide, we'll look at the correlations with EVA drivers. Here's a similar graph from the previous slide, where we highlight the EVA drivers that Gavin went through earlier. Sales growth, EBITDA margin, which is essentially EBITDA margin with the adjustments Gavin mentioned, and the productive capital charge as a percent of sales. This is the capital base times the cost of capital divided by sales. When the rate hikes began in March 2022, we see the capital charge as a percent of sales begin to increase. Note, this is the only time we have shown where higher, this is the only line where higher is better. I'm sorry, where higher is unfavorable. So as rates increase, the capital charge increased, which cut EVA margin, which we saw on the previous slide. If the Fed continues to cut rates, we would expect the productive capital charge to fall, and this declining capital charge could lead to overall better profitability, even if EBITDA margin or sales growth declines somewhat. And with that, I guess I'll turn it back to Andrew to open up for Q&A.
Excellent, nice presentation. Thank you very much to Casey and Gavin. I've put into, please use the chat panel to ask any questions while we have the guys on the line here. And I did put into the chat panel there a link to the interactivebrokers.com contributors category where the ISS work is highlighted. This is the material that I get from Gavin every week, just you know, like free information that we post on the website. Gavin, while we wait to see if the audience does have any additional questions, can you just go through what the service is for people who subscribe to ISS EVA on the platform?
Yeah, certainly. Thank you, Andrew. So as I said earlier, that our research team's producing, I'd say on average, around 8 weekly research reports, which are made up of both Casey's work, which is a lot of, as I said, the quant backtesting work that we've presented here, but also the fundamental research. So in a given week, we're writing what we call a names in the news report, and that could cover 2 particular stocks that have got noteworthy news around them. We then do EVA analysis of those stocks. We've introduced a new report the last few weeks called Prove It Change. So as Casey's been talking about, this profitability risk valuation story, constantly in our framework, stocks are getting rated higher or lower based on their trade-off between risk-adjusted profitability and quality. So we're picking up 3 of those names, doing a little bit more in-depth analysis. We write about industry snapshots, so it might be the semiconductor industry that we're writing one week, the shipping industry we're writing about the next week, and then some of the macro work we've got here. So I think sort of generally the readers will see we've got a nice spread between sort of macro, quant, and sort of bottom-up stock analysis, and then also the company snapshots. So we cover 29,000 companies, which certainly today we don't get asked by any of our investor clients to cover more stocks. So I think we've got a very good coverage, and IBK, our clients, will see those company snapshots on our page as well.
Very thorough presentation. Thank you both very much indeed. There are no additional questions at this time. If you want to reach the team there, EVA Analytics at ISS-stocks.com. And do look out for the link to the recording later on this afternoon in your inbox. Gentlemen, thank you both very much indeed for your time today.
Thank you, everybody. Bye-bye.
Thanks. Thank you for having us.
You're very welcome. Hopefully we'll see you again before the end of the year. And to the audience, thanks for taking the time out of your day to join us. Bye for now, everybody.